All right, today I want to talk about inverse ETFs. So it is possible to make money when the market goes down without shorting things or without having to buy futures or options. So inverse ETFs trade just like regular stocks. There are regular ETFs. I mean, there's a lot going on behind the scenes, but for you just have to think about it as just as though you're buying an ETF. Now, I personally think it's easier to make money in a down market because markets tend to go down faster than they go up. That's because selling is driven by fear and buying is driven by hope. And fear is a more powerful, fear is a more powerful emotion. So this here is the ProShares Short S&P 500 ETF. The symbol is just as SH. And this is just designed to trade inversely to what the S&P 500 does. So if the S&P 500 goes down 2%, this will go up 2%. Of course, it works the other way too. If the S&P goes up 2%, this will go down 2%. But if you think that the market is going lower, this is a pretty sensible place to put your money. You know, it's better than going to cash, which is what a lot of people recommend. And I think that a lot of those people don't even know that there is a such thing as inverse ETFs. You can also use these to hedge. If you have a bunch of stocks and say you think the market's going to go down, but you don't want to sell because maybe you just don't want to take the tax implications or for whatever reason, you can add this to your portfolio. And if the market goes down, this will go up and it could be a hedge against some of your other things that are losing money. Now, if you're really bearish, we can have this. And now this is a good family of funds. I mean, I don't have any affiliation with them, but Direxon, Direxion. They have all kinds of inverse ETFs, various sectors. I'll show you the financials in a few minutes. And as I speak now, we're in the middle of this banking panic, so to speak. And well, I'll show you that one when I get to it. The inverse financial ETF is up 50% in just a matter of a week or so. So now this is designed to go up by 3 times the amount. So if the S&P goes down by 2%, this will be up 6% roughly. If the S&P goes down 5%, this will be up 15%. So if you're really bearish, then you may want to buy this. This is an ETF that uses leverage. So behind the scenes, there's a lot of really complicated stuff going on, but for you, you don't need to worry about that. You just buy it just like it's a regular stock or just like it's a regular ETF. The symbol is SPXS. So SPX is the symbol for the S&P 500, and S means short. So the Direxon Daily S&P 500 Bear 3X shares. Now here's the financial thing. Now, as I speak, we are in middle of March of 2023, and we have this banking crisis going on. Now, this is designed to track the financial sector, or to inversely track the financial sector, and to move by 3 times as much. So you can see here that while the banking stocks have been falling apart, this particular ETF is up 50% in 7 days. So again, you don't need to be afraid of bear markets. We don't really want them, but you don't need to be afraid of them because there's a way to profit from them. And like I said, you don't need to buy puts. You don't need to be a futures trader. You don't need to short. If you're just kind of a starting out retail trader and you have a suspicion that the market's going to go lower, you could check out some of these inverse ETFs. Now, one of the new things that they've just added at this Direxon family is inverse ETFs for stocks. So if you think that a stock is going to go down and you're not someone who shorts or buys options, well, you can buy one of these. So these are single stock ETFs, and these are new. These are only a couple months old. If this one here, AAPD, is designed to move in the opposite direction of Apple. This is not an inverse ETF. This is a leverage ETF, but I'll just mention it while we're on it. AAPU. This is designed to move in the same direction as Apple, but by 1.5 times. So if Apple is up 1%, this will be up 1.5%. So if you're bullish on those stocks, you may want to consider buying these ETFs because you're going to get a better return. This AMZD is the inverse one for Amazon, and they have a bullish one, 1.5 one there as well, AMZU. But AMZD is the bear ETF. GGLS is the Google bear ETF, again designed to move in the opposite direction of Google. MSFD is the Microsoft ETF, bear ETF, designed to move in the opposite direction of Microsoft. And then lastly, we have TSLS, Tesla. This is designed to move in the opposite direction of Tesla. So those are the inverse ETFs for stocks. And like I said, we have these leverage bullish ETFs. So if you're going in the right direction and you get the direction right, you may want to consider buying one of these instead of the shares of the stock. Keep in mind, though, if it goes against you, you're going to lose 50% more of your money than you would just buying the regular stock. All right, so that's it, everybody. I just wanted to really bring your attention to these things and let you know that they exist. And I will talk to you soon. Thanks, everyone.